Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Stansberry Research senior analyst Mike Barrett.
Mike is an old friend. He's worked for us since 2011. He's one of the very best things that has ever happened to me in this business. And I think he'll be one of the best things that happens to you too as an investor. Get your pens and pencils out, take notes. He's a really smart guy. So let's do it. Let's talk with Mike Barrett. Let's do it right now. Mike Barrett, my friend, welcome back to the show. Great to see you as always.
Great to be here. How y'all doing?
Good. You know, I didn't take the opportunity to look up and see how long it had been since you've been on. Do you remember? It's been a while.
It's been about a year, I think. That doesn't sound right to you? I think it was about this time last year. It could have been longer. You know, time flies when you get old, right?
I know. Yeah, I know. We should be talking about this because people say, well, he was just on last year, Dan.
That's what I've heard. Yeah.
Oh, all right. So, you know, with that dispensed it's great to see you. And I think we should let's talk about how you might be thinking about things differently in light of everybody's favorite topic, of course, which is Trump's new trade policy, tariffs, et cetera, et cetera. Do you care about this at all? Do you think about it? Is it part of your analytical process? Like, does this affect you at all as an analyst and as an investor?
Absolutely. I don't think there's any way to ignore it. It's real, and it doesn't depend. It doesn't matter how you feel about it. It's happening, and it's going to affect your investments one way or the other. Whatever you're feeling about Trump and the tariffs, you got to address this and be ready for it. So, absolutely.
So, what in the heck do you do, man? I mean, address it as an investor. Like for me, it's been a bit of a head scratcher because on the one hand, you can see very clear differences between if this tariff regime continues and if he gets what he wants and manufacturing comes back to the U.S., like you can make all those connections, but the time frames aren't necessarily easy to figure out. And for example, this morning I had a thought. I was sitting here kind of staring at my computer thinking, well, it's probably not hard to get a lot of manufacturing jobs back to the U.S., or a lot of manufacturing, but it might be hard to get a lot of manufacturing jobs, right? Maybe they're replaced by robots to a degree that nobody anticipated. So, like, I don't take any of this for granted. It seems like it has obvious implications, but does it really? I mean, I'm struggling here a little bit.
Well, what I do is I try to frame everything within. I pay attention to market cycles. I think the two most important market cycles are the 1-year cycle and the 4-year cycle. Over the long arc of financial history, we see that the stock market tends to put in a significant low once a year. Last year it did in August, and then it puts in a major 4-year low approximately every 4 years. Last time that happened was October of 2022. So in my mind, I say, okay, ideally the next major low is set for October of 2026 or thereabouts. And then I work within that framework to sense where are we going to go from here. So a month ago, what I did was I came up with 3 scenarios for how the stock market was likely to unfold over the next 18 months until October of 2026. And then we began to monitor those and track them to see which one was going to play out. My highest probability scenario was that stocks would bottom imminently. They would move back up possibly to all-time new highs and then decline into this 2026 low. And that's what's happened.
Yeah, I mean that April 8th bottom was pretty a pretty decisive recent bottom, and I think the market was up more than 20% off of that at one point. So pretty impressive. But you say we're going into a 2026 low. Do you have any idea like what part of the year that might happen in, or no, it's just a free for all next year?
Well, ideally, this 4-year cycle plays out. If it plays out as it has in the past, then October, fall of 2026, we would expect a slow. But of course, what happens is sometimes it comes sooner, sometimes it comes later. Sometimes those cycles are 5 to 7 to 8 years. Sometimes they're 2 years.
Okay.
So you pay attention to the things that are happening on a daily basis and how they come into play and how they'll impact that cycle. So one of the possibilities that I was tracking was that stocks don't bottom, that they continue into a major low either later this year or into 2026, and then that from that bottom, then they just move forward. That doesn't appear to be what's happening now. But what's interesting is that I think the bottom is definitively in.
Mm.
The question is, where do we go from here? And in my view, stocks have limited upside from here. And I have a variety of reasons for that. But I mean, everybody thinks, okay, the bottom's in, let's go out and buy stocks. I don't think that's the right approach here for a number of reasons. If you want to, we can get into those. So.
Yeah, before we do that, I do want to get into that. But I noted you said something that I was already curious about. You said the 4-year, essentially what I took from what you said was the 4-year cycle. Let's not get ridiculous about it. It's not a 4-year cycle. It's a maybe 3, 4, 5, 6, 7-year cycle. It sounds like. So you really.
No. It's more definitive than you're making it sound.
Okay.
It really truly is. If you look over a long extended period of time, I know people that have done this. They've gone back into the 1800s and come forward, and they can tell you that every cycle that's happened, divided by however many number it is, the average time from bottom to bottom was about 4 years.
So that's what I mean.
You can count on that.
It's an average. It's not. It sounds like it's an average tells me it's not strict though, right? And you did mention,
Correct.
You said could be 5 or 7. You said.
It can be. And if you go back and look, for instance, after the bottom in 08, we went a long period of time before stocks bottomed again. And then what happens is, to compensate for that long cycle, we have short cycles. Like, for instance, stocks bottomed in 18, they bottomed again in 20, they bottomed again in 22. And in my view, when I looked back over history, I expected that because we had these previous long cycles. And so when you average out the 7s and the 2s and the 3s, what you come up with is a cycle that's about 4 years,
Gotcha.
bottom to bottom.
All right. Now that makes sense. Okay. So with that out of the way then, thank you.
Now we get to the limited. Why do stocks have limited upside?
That's
right. I know you've been writing about it in Select Value Opportunities, but let's explain it here.
We look at a variety of indicators on a daily and weekly basis. One of those things that I look at, of course, is sentiment, and I've figured out how to track sentiment as a single number. That number oscillates between minus 30 and plus 30, with neutral between minus 10 and plus 10. And so what I'm looking for is, on any given day, where is sentiment right now? Is it extremely optimistic? Is it extremely pessimistic? Is it somewhere in between? And so what I'm finding is that, particularly after this positive news on the tariff front, the sentiment has gotten extremely optimistic. And what that means is that investors are making aggressive assumptions about revenue growth and profit margins and the expectations for what stocks are going to do over the next 3 to 5 years. And so a lot of that, in my view, has already been baked. That upside has already been baked into the current prices that they're trading at today. So I won't be surprised if stocks hit new highs, but I just don't know that I could be wrong. And I'm we've hedged in the sense that we've got 8 excellent stocks in the portfolio of Select Value.
Mm-hmm.
And if I'm wrong, they're going to outperform the market just as they've continued to do over the last year or two. And so we'll be good. But in my personal view, based on everything that I see, stocks are extended, the valuations are extended, and there just isn't going to be much upside from here.
Yeah, we are. As you're talking, I'm trying to get a chart up here, and my computer's not cooperating, so I don't know the exact number. But we're not more than like, I think, 5% or so from a new all-time high. So I agree that wouldn't
About 3%.
3%. Okay,
Yeah,
thank you,
pretty
Mike.
close.
Yeah. So yeah, that's not a lot of upside necessarily, but the point is that, upside above that appears to be limited. Of course, if you've ever read, 10 words of any of the digests I've written in the past 3 years, I agree with you. So, I've been talking about a lot.
If sentiment was closer to was more pessimistic about the future, as stocks were coming out of this bottom, and if valuations, one of the interesting things that we can do as far as understanding valuations, whether they're overvalued or undervalued or where the market is we track 100 of the leading stocks traded on the U.S. exchanges, and we rank them every day from the most undervalued to the most overvalued. And over time, what we find is that typically you expect there to be more undervalued stocks than overvalued stocks. But that isn't what's happening right now. What's happening is the number of overvalued stocks. And when I say overvalued, I mean the share price is currently above, and in some cases well above, my estimate of its intrinsic value. A perfect example is Walmart. I've got the value at about $85 a share. It's trading at what, $97, $98 a share. So people have piled into Walmart because they see it as a defensive play as this tariff thing plays out. And again, if you look at it strictly from a standpoint of revenue growth and margins and so forth, the valuation just doesn't. The price that you have to pay for it today just doesn't make sense.
Yeah, it's not much of a hedge at $97, is it? Against a recession.
No. Well, the problem is that they just reported earnings last week. The CEO was very clear. We're going to be hit by. We're going to have to pass some of that hit on if it does happen.
Yeah,
it's already started.
Yep.
And remember that Walmart's. I'm modeling about a 4.5% operating margin. I mean, that's a very slim margin. 2% free cash flow margin. So there's not a lot of room for movement here. Now they admitted to that. I mean, there is some room to absorb some of those hits, but ultimately the reality is they're going to have to pass that on.
Yeah, that's ugly.
Yeah, and that's the thing about when we're talking about the sentiment super positive now. It turned very quickly off just kind of the promise of relaxation of tariffs or some sort of deals or whatever. But I don't think we've even seen the actual impact of them yet, like in all the data, right? Like as far as I see people saying that might come June, July, somewhere in there. What do you think about that? Do you care about that, or I mean, is that, or are you just?
I think you're right on, Corey. I think that investors have forgotten that this is like a Category 5 hurricane that's swirling around in the Atlantic. It's out there. We know it's out there. Is it going to be a direct hit? Is it going to swerve and barely miss us? And I love the way one business owner put it recently. I think it was to Bloomberg. This was after Trump said, I'm going to drop the tariff from 145% to 30% out of China. This particular business owner said, I thought I was going to lose an arm and a leg. I just found out I'm going to lose just 2 fingers. Well, I don't know about y'all, but I don't want to lose 2 fingers. That's still going to be awfully painful. And now Tim Cook, he's been told that his tariff might be a little bit higher. He might lose a whole hand. I don't know. Yeah. So there's still a lot of pain coming potentially. And so we don't know how this is going to play
Yeah.
out.
Uncertainty.
And so to run out and buy stock, I mean, I'm okay owning some stocks, some really high quality stocks here, and we do.
Yep.
But to go out and aggressively buy stocks with this backdrop just doesn't make sense to me.
Yeah. Yeah. The point is well made. Howard Marks wrote a piece about this recently, you know, and Tim Price from Price Value. They both wrote like, you know, we don't know. I don't know. Nobody knows, Howard Marks says.
Right.
You know, the uncertainty, it's not just risk, there's great uncertainty. And those two things are not always, you know, it's not necessarily the same. It's like you say, we see that Category 5 hurricane out there and it could hit, but we don't know where it's going to hit. There's uncertainty about where it's going to hit. And will it still be Category 5? Is there such a thing as a Category 6? You know, could it do that? Like it could be much worse, not as bad. It's just, and especially when you get a capricious fellow like Donald Trump behind all this, you know, the headlines can come so hot and heavy, you know, 10%, 100%, 50%, 30%. I mean, it's just, you know, there's no way to plan for this. You know, there's no way to predict anything anyway, but there's really, you know, you got to be careful about what you do. And I agree, you know, you don't run out and sell all your stocks. If you own like Costco and you've got a huge multi-bagger out of it, you don't sell it, right? But you don't go running after it.
No, and see, that's another one of the stocks that is on our daily report that's overvalued right now quite a bit. And it's funny, when we started this service back in 22, the most overvalued stocks were the big tech stocks, the Adobes and the Microsoft and so forth. Those stocks now are mostly showing up on the undervalued or fairly valued list, and the more defensive stocks are showing up on the overvalued list. So I suspect that what will happen is, if there is a resolution to this and stocks begin to take off, you're going to see the Walmarts and the Costcos and the O'Reillys and the AutoZones and so forth pulling back as people pull out of those positions and move into more risky stocks.
Yeah, but overall, you know, that is obviously a really good, you know, tactical sort of a move to prepare for and to expect and to maybe anticipate and profit from if you see it happening, definitely. But just the overall situation to me is a bit tenuous. You know, overall, I know how a lot of Americans invest. And this is what I'm thinking. I don't want to be too vague. Americans buy stocks every week, every 2 weeks in their 401k. They're overwhelmingly buying the S&P 500, right? So they're not diversified. They've got a third of their money going into the top 10 stocks every, you know, paycheck. And I'm just afraid that their returns over the next 5-10 years, as they, you know, seek to retire, perhaps many of them, will be really, really disappointing from here. You know, and as the way I see it, it's the perfect setup now for a sideways market, because I think most people, myself included, until very recently, think, well, we've had this kind of really long, incredible bull run. You know, the market is 60x since 1980. I mean, it's just S&P 500, right? From 100 to 6,000, basically. It's incredible. You can always buy the dip, et cetera, et cetera, et cetera. And the reason for it, I think, is something people are just only now learning about, which is that, you know, the maker, China, we've sent all these dollars to China. They've come screaming back into U.S. investments. And, you know, trade and investment, they tend to flow the same way. So when the trade flows differently, the investment will flow differently. And I think that's the one big thing that could finally derail the endless bid under U.S. stocks. It's been an endless bid. That's my great fear right now, is a sideways market that just beats the crap out of retirees for the next 10 years.
Well,
I try to. That doesn't sound very fun.
Yeah, I mean,
I was just, you know, I try and select value to just stay close to where we are now and look out just a week or two, or just anticipate by just a step or two where we're going to be. and try to stay ahead of wherever that is. I just have learned over the years that I'm not very good at making these big directional calls, and that there seems to be a lot of risk. It's like, I love the way Howard Marks says, you can be directionally correct, but if your timing is off, you might as well be wrong. Yeah. And so I have just learned the hard way to just stay focused on what's happening right now, what I can anticipate over the next few weeks, and work with that.
Yeah, a few weeks. That's not a bad time frame to work with. So let's talk more about how you do that. You're obviously looking at good quality companies. You're waiting for them to be attractive by valuation. It sounds like, which is most people would say, well, that's not a timing mechanism, Mike. How can you buy value and look out over 3 weeks? Can you put those two pieces together for me?
Sure. Yeah. So valuation is only one of the things that we're looking for. We insist on both valuation and momentum. Because one of the things that's very important for people to understand is a stock can be undervalued for months, if not years, until there's a catalyst until there's a catalyst that's drawing people to buy it, and that could just be as simple as a broad market upswing that people have decided, hey, these stocks are undervalued, and we're going to move into them. So what I also do on a daily basis is I monitor momentum signals on these 100 stocks. I look every single day, and I keep track of them. And so we insist on there being not only an undervalued stock, but one that's triggering one of these momentum buy signals before we buy it.
All right. That makes sense. You are, I haven't been keeping good track, but you're one of a handful of folks, a couple of them from around the MarketWise universe, who have talked about this combination of fundamentals and momentum. That's and people have been doing that for some time, but mostly a lot of people still talk about fundamentals or momentum, but you're putting them together and creating a system that has done pretty well, has it not?
Yeah, it has. And my mantra, and the mantra that I live by, and the one that I've used for this service, is figure out what works, then keep doing it over and over again. I mean, it sounds simple, but it's not. As an aside, when I went in for my physical a few months ago, the blood test results come back. Doctor says they look like you're a healthy 20-something. And that's great news for an old guy like me, but it's the culmination of decades of doing the little things like getting 2 hours of exercise each day faithfully and not diverging from those things, and doing them day in, day out, year in, year out. And so it's the same thing with investing. What I've learned over many, many years is that don't get pigeonholed into value or momentum or some other thing. Put it all together into a system, figure out if it works, and if it does work, stick to it and keep using it.
Now, if I know Corey,
Excuse me.
If I know Corey, he's wondering, wait a minute, Mike, 2 hours every day?
You know me well, Dan.
2 hours a day.
That's amazing.
What are you doing? You're running?
2 hours a day.
Running, walking? What are you doing?
Well,
Golfing?
it's funny. Now that I'm 64, what I do is different from what I did at 44 or 24. Although I like to say that I'm 64 going on 34, because I still have a lot of aches and pains because I still push it pretty hard. But I weightlift every day. I play basketball every day. I swim every day. I ride my bike every day. Sometimes I just do hard labor around my place. That qualifies for all of that. So, it's a variety of things. And I'm fortunate that it's all here at my place, that I can do it. I don't have to get in the car and ride to a gym or anything. So, but yes, I shoot for the 2 hours a day. I get up early so that I have plenty of time. I'm usually done work at 4, and then from 4 to 6, I'm outside getting my exercise.
Well, I want our listeners to know that this doesn't surprise me. I know Mike to be I sometimes say, I wish I were more like him, and this is one of the many ways in which I were more like him. I actually get a decent amount of exercise. I think I lift some weights, a few times a week, and just try to keep in motion when I can. But yeah, 2 hours a day. That's impressive. And I thought the plantation would kind of, be part of the equation there. But what's the state? What's
Yeah.
the state of the plantation right now? You're not. Last time I talked to you, you weren't producing or something. There, it was.
Yeah, it's been a tough few years. We had another, talking about hurricanes. We had another major hurricane hit us direct last year in October.
Right.
We survived that. The place did pretty well. The trees were fine. What's interesting is that we had about 10.5 inches of rain. That was on top of historic high levels of rain over the last 2 or 3 years, and so water table is very high. Pecans don't like that.
Mm.
So what's funny is that it's like as soon as the storm came and went,
Mm-hmm.
somebody flipped a switch and turned us into Arizona, because for the last 7 months it's basically not rained.
Wow.
Now that's okay. That's mostly okay, but like my saw palmetto crop is pretty much toast this year. I had a great crop last year, harvested nearly half a ton of berries. I probably won't get 100 pounds this year because it's so hot and dry. But this is what happened. This is farming. Farming's like investing, Dan. Yeah. Every year there's some new exciting challenge that you're going to have to deal with that you're not, it's hard to anticipate.
So I have to tell my one farming joke now. Okay. I heard, and this was real. This was real. It was a radio interview, which tells you how long ago I heard this. And it was a financial show, and there were 3 guests, and one of them was a farmer, and the other 2 were like financial people. And the host said something like, "What would you do with $1 million right now?" And the 2 financial guests said something like, T-bills and stocks, or, real estate or something like that. I don't, the memory is fading, so I don't remember exactly what they said anymore, but I remember what the farmer said. The farmer said, "Well, I guess I'll just go on farming until it's gone."
Yeah. Amen, brother. Oh gosh.
Yeah, so
I don't think most people appreciate how capital intensive farming is, and I really have great respect for my farmer brothers and sisters out there who do this for a living, because man, it's tough.
Yeah.
You just because the tariffs are hitting and prices of all your inputs are going up doesn't mean your crop prices are going up. They could be going down.
Yeah.
And I just saw a headline recently that farmer defaults are starting to rise, and it's tough. Really is tough.
So are the Chinese still buying up all the pecans?
Yeah, I think so. They get the best of the best.
Wow.
I haven't
The
talked
Chinese
to
are just
those
like,
guys in a while.
the Chinese are like, trade war, real war, we don't care. We must have pecans.
Well, when they're willing to buy your entire crop right off the, put it all on the boat and ship it overseas, that's a great deal.
Yeah.
Or at the front end of the year, at the season when the prices are best, that's a good deal.
Yeah, I can see the meetings, at the top levels of the Chinese government, and they have a list of priorities, and it's like pecans, copper, oil. Oh boy, I've learned so.
They're smart.
Yeah, they are. I've learned so much from you, Mike. I really have, about all kinds of things. In fact,
that's another thing that's helped me. That's helped me keep my health good, is eating walnuts and pecans. So they've got a lot of tremendous health benefits. So I encourage everybody to do the same if they can.
Do you drink alcohol, Mike?
No, I don't.
Have you ever?
I don't, and oh yeah, when I was in high school, when I was in college, yeah, I did my share. But it's funny you asked that, because we recently went up to New York City for my wife's birthday, and we got delayed on the way back, And so I had to kill some time reading something.
Mm-hmm.
Picked up a Men's Health, which I used to read every month, but hadn't read it in a while. So they had this inset about your liver. And I started reading. It's very interesting. It's just factual. And at the very end, the only thing that I remember from the entire inset, which was really fascinating, was this. They talked about drinking, talked about alcohol. And they said, every time you drink alcohol, a tiny piece of your liver dies. And I thought, okay, well, I'm glad I don't drink anymore because I don't want a little piece of my liver to die every time I drink. So there you go. I'm not saying nobody should drink. Right. I'm just saying that I just made a conscious decision to not drink. That doesn't mean I won't from time to time if I go to a wedding or something, oh, sure, I'll have a drink. But I just made the conscious decision not to drink anymore. I don't want to lose a little piece of my liver every time I take a drink. Okay,
well, that's good to know because, I drink almost every day. So maybe I'll cut back on the frequency. I've heard that before, and I've always thought, boy, I hope it's a really tiny piece. I mean, either that or I hope I have an unusually large liver. Just I hope I have spare liver.
Yeah, I feel like I lost too much of mine when I was younger too. Already,
Yeah, right. I mean, that's what you start thinking about. Okay, well, when I was in my 20s, and I drank more than I should have. But you find that as you get older, you should do less of those things. And if you're wise, you do. And if you don't, then what happens is options start getting taken off the table for you. And I don't want that to happen. So.
Yeah, that's very wise. That sounds like my dad used to say, keep your options open. And it would be, health and finances and all kinds of things.
Right. Yeah.
Speaking of options, do you ever trade options?
No, we don't do options at all. I traded them in my early investing career, had a little bit of success more with commodity options and futures than I did with stock options, but never really got excited about it. Just wasn't my thing. I think that, I'm talking about what works, figure out what works and keep doing it over and over. That's part of the process, right? You're an investor, you're a new investor. Maybe options is your thing. Maybe some hybrid deal where you trade stocks and have options on stocks. That was never my thing. I had to figure that out. I think every investor has to figure that out. What's my deal? Is it just buying stocks and bonds? Is it just buying mutual funds? Is it options? Is it commodities? Whatever it is. And so you have to experiment a little bit, take some risks, check it out, try it out. And that's what's great about MarketWise, right? We've got all these different products to help people not have to start from scratch as they go on those different journeys.
Yeah. It's good to get those mistakes out of the way when you have a tiny amount of capital.
Right.
Early in your life. I made some of those myself.
Definitely.
Yeah,
me too. Mike, I'm looking through your rankings list right now. And you mentioned the tech stocks, some of them undervalued. I gotta say, I'm surprised that you've written about NVIDIA before. I'm pretty surprised by how much undervalued that is right now. I mean, what are your thoughts on what's going on with that stock right now?
Okay, well, I may have a totally different, as a caveat, I may have a totally different opinion after tomorrow when they report earnings.
Right.
But I mentioned this earlier that I think I mentioned it earlier. The three most important inputs for valuation are revenue growth, profit margins, specifically operating margins, which ultimately impact reversion value, and free cash flow margins. Let's talk about NVIDIA. This is a company growing year over year, 50, 60, 70%. Okay. That's down from 110%, some crazy number. Operating in free cash flow margins in the 50, 60, 70% range. I mean, it's just astronomical what this company's been able to do. They're minting money quarter to quarter. Of course, the question is the future. Where do we go from where we are now, and what's the expectation in the future? And I think my estimate of value is about $200 a share. Is that what it says there, Corey? As you look at that list?
Yep, exactly.
Okay, so my expectation in coming up with that number is that, and I'm pretty closely aligned with FactSet, the analysts who form the consensus of analysts who cover it and report on FactSet. We expect the growth to diminish pretty significantly. I'm only forecasting like 25 to 30% growth over the next 5 to 7 years, diminishing from what it is now. I'm looking at margins diminishing from where they are now. I mean, it's just natural, right? This isn't just an NVIDIA story. This is what happens. I mean, you've got AMD, you've got other companies, you've got white box manufacturers that come in and steal little pieces of market share. Mm-hmm. This is just the reality of what happens in a capitalistic society. So, but here's the point of all this. Even when you make all those adjustments and you come up with a $200 share price based on 20 to 25 to 30% growth, which is about half of what it is right now, actually, and you come up with a $200 share price, that means that if you buy it today, NVIDIA, you're paying your implied growth rate is like 10 to 12%. So is NVIDIA going to grow at 10 to 12 to 15% looking forward? I think so. Now, again, we may find there may be something that we learn tomorrow that changes that algorithm, but that's the way I approach valuation, and that's what's worked for me. That's what's been very successful for me.
So, Mike, when we were exchanging emails about preparing for this podcast, you mentioned you wanted to talk about a couple of names that we have in extreme value, one of which was Road, ticker symbol ROAD, Construction Partners. I don't remember now. I'm looking through emails trying to find it. I can't find it. I don't remember now why you wanted to talk about that. What was on your mind with that?
Yeah, well, I'm glad you brought that up, because one of the questions that people have, subscribers have, is, okay, what you got these two value-focused newsletters, and what makes them different? I mean, we've talked about some of that. I have other aspects like momentum that I introduce into my system that we don't pay close attention to in extreme value. But I think the point I wanted to make about that is, when we buy a stock in extreme value, our preferred time frame is forever. We'd like to buy it today and know that we never have to sell it.
Yep.
Of course, it doesn't always work out that way, right? Most of the time it doesn't. Yep. But the idea is that we want to compound value, we want to compound wealth over a long period of time. And Construction Partners, as you mentioned, really embodies what we're trying to do at extreme value. We bought it in 2021. It was, the pandemic was still going on. It was cheap in relation to the growth expectation that we had, which is where most of the time value is found, is in the mispricing of growth. And what I love about the stock is it's the largest asphalt paver in the Southeast United States. Georgia, Florida, Alabama, South Carolina, North Carolina. These are its key markets. What they do is they go out and they acquire. There's thousands of these asphalt paving companies. They go out and acquire them little by little. And before you know it, if you look back over the time that we've owned the stock, at the growth in EBITDA and revenue and free cash flow, it's just incredible. And so if you can buy these kinds of stocks early and get in at a good price and then hang on through the tough times, it's amazing what they can do for you over time. I think we're up 350% on that one. Mm-hmm. We're up like 550% on Sprouts. Here's the other thing that I wanted to talk about, is that sometimes there's an optionality associated with these kinds of stocks that you get, you don't have to pay for. It's like a free option. So in a way, we do trade options. We get free options sometimes. And what I mean by that is, here's a perfect example. I told you that it's a Southeast oriented paving company. What they've been talking about this for years. It's now happening. They've moved into Texas and Oklahoma. Now, you can imagine how many thousands of paving companies there are in Texas. Yeah. And so I expect that EBITDA growth and that revenue growth and so forth will just continue to, I'm hoping that 5 years from now, when you have me on this, we still hold road, and it's now 2, 3, 4 times bigger and more valuable than what it is today. I'm not saying that it's undervalued today. I'm not saying Sprouts is undervalued, but I wanted to talk about those as ideas that sometimes if you have a long time frame and you're patient, one of the things that's interesting about Sprouts, we saw this same opportunity for it to grow strongly when we bought it back in 2021, I think. Mm-hmm. What we didn't anticipate, because we didn't know about it at the time, was this obesity drug craze, right? And so what's happened is, now that people are losing 100 pounds, 150 pounds, 250 pounds, they don't want to put it back on. They're eating better. They're staying away from ultra-processed foods. They're eating more fruits and vegetables. They're eating the things that Sprouts focuses on and is a leader in. And so it's kickstarted the stock. It's been a wonderful option that we paid nothing for when we bought it in 2021.
Right. That's, for our listeners' sake, Sprout Farmers Market, ticker symbol SFM. And as Mike said, it's been wonderful. And he makes a good point there. We buy these things when they're most attractive, but ideally speaking, they're not trades. They're investments for the long term. And excuse me, we mentioned Costco as well. We have that in the extreme value portfolio as well. And as he said before, it's nothing you'd want to buy right now because it's very expensive. So the return from this moment might not be great, but that doesn't mean you'd sell it because we bought it when it was cheap. So you want to hang on to that for the long term because it will continue to be a phenomenal business, I believe, for some time. It's actually, Costco is one of the ones I really like to talk about because it's so simple. You go to Walmart, they've got 150,000 SKUs, products on the shelf under an enormous space, and under a also enormous space, Costco has 4,000. So it's they got 2 kinds of mustard instead of 20 or whatever. And they just move it and move it and move it, and they turn inventory actually more frequently, and it's a pretty phenomenal thing. And then they make you pay to go shopping there too, which is pretty wonderful. The whole thing is really cool.
Yeah, and what's great about that is that throws off a couple of $1 billion or whatever the number is, and like 99% profit, and so it turns into pure cash flow.
Yep.
And so they already operate on a very thin. I think their operating margin's even lower than Walmart's.
It is. Which
creates this wonderful moat around the business, right? Who in the world can compete with a company that's earning a 3% profit margin? So
right.
It discourages new entrants into that business.
Yeah, Costco, when I've looked at the net margin over the years, it's been like less than 2, consistently less than 2. But it's so consistent. That's the amazing thing. And you talked about that in your personal life, consistently exercising 2 hours a day and consistently doing all kinds of things that have kept you healthy. And, businesses are the same way. If they can do something consistently right again and again and again, the way Costco does, and Walmart too, and, Sprout and these other companies that we're into, it's an amazing effect. And that's, you can just sense the compounding and the consistency of their business model and the results that it generates. It's really that's why we emphasize in extreme value the 5 clues, because we're looking for consistent free cash flow generation, consistent margins, a consistently good balance sheet, and a consistent, capital allocation policy, with dividends and share repurchases and other things, consistent returns on the capital they invest. when you get those things consistently, it almost, I'll say almost doesn't matter what the actual numbers are, right?
Right. Yep. You're absolutely right.
Yeah.
Good point.
Yeah.
These are always the
But
companies.
you have.
These are always the companies that I hear about, and I wish I had put some money into like 10 or 15 years ago and just left it there, because
Right.
I'm looking at
Right.
Construction Partners, the chart right now, and
Oh yeah.
I think as we speak here, it's already making a new all-time high, you
Yeah.
know, and
Yeah.
and so I think the point, and like Dan, to your point, if you're concerned about like a sideways market for a long time, or just the behavior of the indexes in general, like if you have these companies, I feel like these are the ones that tend to just are consistent, right, for you,
Right.
just like over time, and that's what you want, especially if you're in retirement, near retirement.
Right. And if I'm right about
and
that,
then if you're like me and younger, I just wish I had, put
Yeah.
more, put some more into it, and then just let it compound for 50 years, and
exactly.
we'll be good, hopefully.
And if I'm right about that sideways market, Corey, here's the thing. Your returns over the past, whatever it is, decades, pick your number, 2, 3, 4 decades, have come very often from the elevated valuations that are concerning Mike and I right now. That if I'm right about the sideways market and the effect of a whole different global trade regime, if that really comes to pass, its asset prices will suffer. But if you own these high quality companies and they continue with this consistent business model that they're able to do, the returns will be there. They'll just come in a different form. They'll buy back more stock or they'll pay bigger dividends. The returns, when the cash is there, the returns are there. That's where the returns really come from. They're not supposed to come from the market saying it's worth 70 times earnings, right? That's not where returns really are supposed to come from. So you can tell how excited, the high quality businesses get Mike and I all worked up, and you too, I know. Yeah.
No, they get me when I own them, and I see, see like I'm thinking of, I really, one of the things I learned working at Stansberry was the value of these insurance companies.
Yep.
And just over time, and it's
there
really
it is.
remarkable. Like once I
Consistency.
started getting into the macro end of things and thinking about those things, I'm like, well, these insurance companies, they're trying to figure all of this out. They're actually trying to figure all of this out, to like from the gyrations of the economy and all the all the Fed stuff and interest rates and whatever you want to get into.
Right.
They're trying to think that way too, and maybe more so than other businesses. So to me, that made sense as well. And so that was appealing. But yeah, when you, like, there's W.R. Berkey, like
Berkeley, yeah.
Japan, a Japanese company just decided, hey, we're going to buy, you're a good company, we're going to buy 15% of your shares outstanding.
Mm-hmm.
And you want to talk about optionality, like, okay, did I know that was going to happen? No. But if that's good for the stock, I would say so.
Right.
Yeah. Gosh, Berkeley. Brian Beach, who is our colleague at Stansberry, we've had him on the show a couple of times. He shot an email around the other day. I don't know, Mike, if you were on this thread, but he said he said, you guys at the Stansberry Investor, the Stansberry's investment advisory, you've been taking like victory laps on Barkley for 10 years or 15 years, whatever it is. But the person who originally picked this was Dan Ferris, because I picked it I bought it in 2008. It was one of like a handful of stocks anybody picked that year that actually went up, because they were buying their investment portfolio. Their underwriting is just iron consistency. That's one thing. And then the investments were iron consistency because they were buying like muni bonds. They weren't going to lose money. So
right.
And they've continued just doing the same thing. And all you had to do was listen to the CEO, Berkeley. He got on to a conference call and he said, he started to speak and he was very calm and very authoritative. And he started off by saying, property and casualty insurance is a long-term business. And I went, amen. Like back then, like, amen. In 2008, somebody's telling you something is a long-term business. Amen. And he's right. And that's the way they run it. So yeah, love those companies. I love those great insurers.
have you to thank then for
I know,
finding that one. But
yeah, I'm just patting myself on
glad
the
I,
back
glad we,
there. You know?
I'm glad you said that. Yeah, I'm glad you said that. Well, and it's another one. It's right. It's family owned. It's a lot. You know,
Right.
is the CEO and the largest shareholders.
Mm-hmm.
And that's something we've talked about before too. You know, those kind
Right.
of companies that have this long-term staying power with the cash. Like that's, I don't think. I mean, those are like the best of the best, I think.
All right. So I need to tell our listeners that as a newsletter writer guy, I think Mike Barrett he competes for one of the top 2 or 3 things that's ever happened to me. Although arguably, you know, happening upon Porter Stansberry many years ago as a roommate was probably a little better. I'm just going to say,
I'd say that was a whole lot
yeah.
better.
But Mike, I always get the year wrong. You started with me in like 2010. Am I right? 11. I always get
March
it
of
wrong.
11.
And one of the first things he did was he found Constellation Brands, which then was you know, it still got beers and spirits. You know, it's an alcoholic beverage company. Still it's our best closed pick. Like we got a 650% return out of that one. And I think right now we're up to about 1,000% out of ADP, which I bought in 2008.
Mm-hmm.
But he worked on me for, I don't know, it was a few weeks or so, and he sent me this idea, and I can't believe, I'm embarrassed almost to say it. At the first time I thought of that, I don't know. I was like, I don't know. I mean, alcoholic beverages, gushing free cash flow. It was a no-brainer, you know. And Mike's emails were very humble. You know, he's like, I think this looks pretty good, you know. Like, if it would have been me, I was like, you're dumb if you don't buy this. That's probably what he was thinking, but we did, and it worked out extraordinarily well. So, and from then on, I was
our timing.
Go ahead.
Our timing was great because we got in 6 months or so before the Corona deal.
Right. Yeah.
Once the Corona beer deal happened, I think that next day the stock shot up 30, 40, 50%, and then never looked back.
Yep. Yeah, it did. I was like, whoa. I mean, you know, it was a huge
Another one of
win.
those optionality deals.
Yeah.
So, yeah.
Right. You never know. And the way the deal worked out with, you know, they really just have the Corona name inside the United States, right? The big market for it. And they can come up with new products, like they own the brand inside the US. So it's a pretty awesome arrangement. Yeah. Great things happen to great businesses. You know, it's sort of like they make their own luck, don't they? They do everything right. And then you have options that you just don't have when you're, you know, a crappily run mining company, for example, which we've managed to avoid.
True.
Yeah. Yeah. The learning of life is about what to avoid, to a great degree, I find.
Mm-hmm.
You know, avoid garbage in your portfolio. And right now, I keep telling people, Mike, maybe you can, you know, identify with this. I keep saying, like in the digest and in my newsletters and things, right now, you have been given a gift, which is a chance to unload all the garbage you might still be holding on to, right? When the market's this elevated, people are crazy about AI. I mean,
yeah, that was a great point, Dan. When I saw you wrote that, I was like, thank you for writing that. Yeah, it's exactly, if you want to right now would be a great time to unload those things.
Mm-hmm.
Right. Yeah. You'll feel smarter in the end, won't you? Than if you hold on. Mike, do you like crypto? Do you own Bitcoin?
I do own a little Bitcoin. I do own a little bit of Ethereum. But I own just enough. When I owned quite a bit more of it and sold when it went into that meltdown a few years ago. But my base cost basis was so low that I made a pretty significant amount of money, and I haven't looked back. I got a nice chunk of change. I got my money back at a time when people were really worried if it was going to stay on the board. And I kept hold of the sum, enough of it to, if I don't have to worry, if it goes up, I'm going to make some nice money. If it crashes to zero, I'm not going to lose that much.
You're right where I am. Bitcoin put a pool in my backyard, and I have enough left so that if it skyrockets, hallelujah, and if it goes to zero, who cares? Yep.
Yeah. Right.
Now, Corey, if your
Yeah,
Bitcoin goes to zero, you'll care, as I recall, right?
I'll care some more, but yeah, haven't put a pool in yet, Dan. But
Okay.
we're working on it.
All right.
Yeah.
Okay, it's time for our final question right now. It's the same question for every guest, no matter what the topic, whether it's financial, non-financial, whatever, identical final question. Mike, if you've already said the answer, feel free to repeat it. And the question is simply, if you could leave our listener with a single thought, a single takeaway today, what would you like that to be?
Well, I knew you were going to ask a question kind of like this. I couldn't remember exactly what it was, but so I've been giving it some thought, and we haven't talked much today about a generative AI and how wonderful it is, how awesome it is in so many different ways. Besides the fact that it's AI stocks and all that, where it's not got anything to do with that, just the ability to use this service on a daily basis is wonderful. At least that's been my experience, and I'll tell you in a moment why I'm getting at this. For instance, I think I've told you I'm in the middle of writing a book series about the Bible. I've been working on it every day for almost 3 years now.
You did tell me, yeah.
And I use Gemini daily to find scripture passages that I can't remember. I can't remember exactly where the great commandment is, for instance, in Deuteronomy. I type into Gemini where immediately it tells me where it is. So it's been a wonderful resource for me. But I wanted to leave readers with this. It may be of some value to them. I used Meta AI sometime last year to help solve an age-old problem for myself. I told you earlier that I have been doing things every day personally forever. One of those is having a protein shake. And inside that protein shake are about 13 things that I put, one of which is a banana. So I eat a banana every day. What's one of the most difficult things in the world is to keep bananas from over ripening. You go to the store, you buy them, you put them on the rack in the kitchen, and within 2 days they're starting to spot up and they taste weird, and you end up having to throw them out or turn them into banana bread. I thought there's got to be a solution. So I said to Meta AI, what's the best temperature to store bananas so that so they stay? I think it told me like 52 degrees. Okay, well, your refrigerator's 35, just above freezing. Your room temp's 70s, and bananas need to be somewhere in between. I said, okay, so what's the solution? They immediately told me, get a insulated lunchbox, which of course we had several of those in the house. Get an insulated lunchbox, stick the bananas inside of it, stick it in the refrigerator. That way you reduce the temperature, you improve the temperature inside the lunchbox from the 30s to somewhere in the 50s. And so I've been doing this now for not quite a year, 7 months, and wow, it's awesome. I don't have to worry about bananas ever spotting again. I put 6 or 7 of them in a lunchbox, stick them in the refrigerator, and I can eat every banana in the bunch over the next week without it ever the taste turning bad or going bad on me. So I just throw that out there in case somebody else is tired of buying bananas and then having to deal with it 3 or 4 days later when they go bad.
So for sheer uniqueness of answers, I think you may be you're top 2 or 3 at least, Mike.
That's what I was shooting for, Dan.
Yeah, I won't be forgetting that one anytime soon.
No, I won't either. I have two relatively little kids who eat bananas every morning for breakfast, and I think my wife will be very happy when I tell her this later today.
Great.
That we're gonna.
Great.
So I'm shorting
thanks to AI.
futures.
It's the real deal.
I'm shorting banana futures.
Thanks to AI.
So yeah. All right. Listen, Mike, it's always a pleasure to talk with you, and I'm really glad that we were able to do it once again. Thanks so much for being here.
Yes, sir. Enjoyed it.
All right. We'll talk to you again soon, too. I promise.
Okay. Sounds good. You're not going to forget the next time.
That's right. I'm not even going to mention, the last time. Next time, we're not going to bring up the memory of 60-something dudes.
We're going to talk about the last.
Sounds good. All right. Take care, guys.
You bet.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.